Imagine waking up tomorrow morning and discovering that the entire global economy suddenly stopped using the US dollar. Supply chains would instantly freeze, stock markets would violently panic, global wealth would be completely locked, unable to move across any borders. To understand how a single currency holds that much power, look at how normal trade works today. If a manufacturing company in Brazil wants to buy electronics from South Korea, they rarely trade reais for won directly. Instead, that transaction is almost always routed through the US dollar. The exact same routing applies to energy. When a tanker full of oil leaves the Middle East bound for Japan, the final invoice is priced and paid in greenbacks. For decades, almost every major international exchange has relied on one country's money as its default unit of account. The dollar operates as an inescapable middleman, processing the daily survival of the global economy. At the close of World War II, the industrial bases of Europe and Asia lay in ruins. The United States emerged in a unique position, with its domestic factories remaining intact and operating at full capacity. Beyond its manufacturing output, the U.S. spent previous years accumulating the majority of the world's physical gold reserves, giving it unmatched economic leverage. Recognizing the urgent need for a stabilized post-war economy, leaders from 44 allied nations gathered in 1944 at Bretton Woods, New Hampshire, to draft an international financial architecture. They designed a strict hierarchy. Under this agreement, participating nations would peg their local currencies directly to the US dollar. The United States, in turn, promised to tie every dollar to a fixed amount of physical gold. By establishing this legal framework, the agreement demoted the British pound and formally installed American currency as the standardized foundation of global commerce. In 1971, the United States suspended the dollar's convertibility into gold. Many economic observers expected the currency's global dominance to collapse without a physical metal backing. It didn't. Over the previous 3 decades, foreign banks, corporations, and governments had woven the dollar so deeply into their daily operations that tearing the system out would have been unsustainably expensive. Crucially, the global trade in oil remained strictly priced in dollars. If a nation wanted to import the fuel required to keep its domestic power grid running, it had to pay with American money. This forced requirement elevated the dollar to a reserve currency. Foreign central banks and major institutions are obligated to stockpile massive emergency funds of U.S. cash just to maintain access to international trade. The global economy is locked in a self-sustaining loop. Everyone uses the dollar because everyone else accepts the dollar, making it a technical requirement for anyone entering the international market. Because foreign governments and central banks need a secure place to store massive dollar reserves, they routinely park cash by purchasing U.S. Treasury bonds. This endless global appetite from overseas buyers allows the American government to issue trillions in national debt at significantly lower interest rates than it otherwise could. Beyond the domestic discount, this setup creates an extraordinary geopolitical weapon. Controlling the primary routing networks for the world's money, Washington effectively operates a global financial toll booth. This mechanism drives modern economic sanctions. If the U.S. cuts a rogue nation off from dollar-based clearing systems, that country is immediately starved of international trade, unable to buy imports or sell exports. Reliance on American money hands U.S. politicians a tool of compliance that reaches across continents, frequently substituting the deployment of military force with a stroke of a pen. Competing economic powers naturally look for workarounds to avoid this vulnerability. The euro serves as a regional alternative, and China has spent years pushing its trading partners to adopt the yuan. Yet these alternatives consistently hit a ceiling. They lack the institutional scale and deep market liquidity required to absorb and safely process the daily movement of global wealth. This chart shows the sheer volume of the U.S. Treasury market compared to the debt markets of rival nations. That disparity points to a requirement competitors cannot easily manufacture: investor trust in transparent legal frameworks where vast assets can be bought and sold in seconds. You can observe the strength of this trust during economic panics. Even when a massive financial crisis originates directly inside the United States, global investors predictably rush to buy more US dollars as a safe haven. The dollar maintains its throne because it sits on decades of tested institutional reliability. Let me know down in the comments. If that trust disappeared tomorrow, what system has the scale to replace it?